and I know this is a dumb question, but we're lowering interest rates, and the Fed has been kind of pressured to lower interest rates, but we're lowering them below historical average. What's the point of that? And what is not? Why would we just not stay at historical average? Like, what is the catalyst that's making the Fed believe we have to lower rates?
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters. Today I'm with John Martfeld.
Good morning.
And Lee Mackey.
Good morning.
We got a couple topics we want to talk about, but real quick before we get started, Zoe sent out an Instagram post and an email yesterday to all the Market Moment followers and subscribers asking for your input, right? So we always want these to be relevant and be talking about things that you want us to talk about. And so this email was a survey just asking you what's important to you guys. What are you most concerned about relative to the markets and politics and inflation and all of that kind of stuff, the economy, giving you an opportunity to give us some feedback and some ideas on what you would like us to talk about. We're going to have a special episode kind of specific to that coming up either the week before or the week of the election that we're going to really dig into some of that. But we'd love your feedback. So please jump in there, fill that out, and we would greatly appreciate it. And as always, while you're doing that, like, subscribe, and give us a comment. So there's my plug for the day. So
we have an election coming up?
We have an election, yeah.
Where have I been?
Your head has literally been buried in the sand if you didn't know that. So what we're going to talk about today, so the Fed cut rates in September, right?
Yep. 50 basis points.
50 basis points. So what has the market historically done when the Fed started a new rate cutting cycle? Okay, so the Fed, they think they're like, all powerful when it comes to the economy and the market, and they control everything. I say that somewhat sarcastically, but they do think they have a lot of control. And they pull these levers and they decrease rates, they increase rates based on different factors and what's going on, and if we need tightening or softening of the financial situation. So they started cutting rates. So what has the market done, in the first 6 and 12 months following the beginning of a rate cut cycle? So I've got a couple just random facts here. What's interesting is when you start to dig into this, there's all kinds of articles and research out there.
Oh, yeah.
The answer becomes depends.
Yeah.
Yeah, exactly.
Yeah, and you kind of have to
Usually, sometimes
dig in. One of the first ones that pops up, looking at Morningstar. So stocks have performed well 12 months following the first rate cut. This is just going back to 1974, so it doesn't go back as far as some of the others. But stocks have been positive 80% of the time. So this is 12 months following the beginning of a rate cut with the average return of 15%. Okay, so that's kind of the first one. If you go back to 1929, so a lot further back, almost 100 years, there's obviously a lot more data samples and data sets to look at, but the market has done well. Stocks have outperformed bonds. Bonds have outperformed cash. Stocks have been up 12 months following the beginning of a rate cut cycle, all but 6 times. And typically those times have occurred when the Fed started cutting rates in a recession, right? So you have different scenarios of why the Fed would start to cut rates. Is it just a kind of normalization cut? They're just trying to get rates back down to where they need to be so the spread is normalized, or are they cutting in kind of a panic scenario where it's like things are falling apart, we got to cut. So those, the market has reacted different based on the reason of why they're cutting. Bonds have historically done well, not as good as stocks, but they're still positive, outperforming cash, both on the government side and the corporate bond side of things. So I've got some more stuff, but you guys jump in here. What are your thoughts?
Well, just like you go ahead, Lee.
No, I was just going to say, it really boils down to recession or not a recession. Right. The data I've looked at, you were looking at a year, 6 months after rate cuts. Oftentimes the market's down in that period of 6 months.
And a lot of times the market sells off going into it.
Yes.
And it kind of. Yes.
And so to your point, if the economy is not in a recession, equities tend to perform well, and definitely outperform fixed income and cash. But to Matt's point, if it's in reaction to, man, the economy has tipped into a recession, things are not good in the economy,
right.
then things don't typically bode well for the markets in the 6 months anyway, preceding or immediately after a rate cut. And I think that where we find ourselves right now is, there doesn't appear, at least right now, to be a recession on the horizon. And
yeah, I mean, I look at it like,
come up.
how nice is it when the interest rates are low, right? It stimulates the economy. It's more borrowing. Houses become less expensive. Businesses are able to borrow more money, and that's what happened to us for a long time, right? When we had that low interest rate cycle. But I'll read a couple little stat lines here. Excluding the rate cuts that happened during the pandemic, the Fed has had 6 cutting cycles since 1990. Starting from the point that the Fed began cutting, the economy has fallen into a recession 18 months later on average. Right? So since 1990, the 6 cuts have led to a recession 18 months later. That's a long time later to look at that. In other words, not something you worry about in the short term as far as that goes. As a general rule of thumb, when the Federal Reserve cuts rates, it causes the stock market to go up, and we kind of talked about that a little bit here. But here's something I thought was interesting. And we talk about interest rates a lot, and I think young people especially have gotten used to this incredible low rate environment, and they think that it's, we're going back to normal. The benchmark interest rate in the United States was last recorded at 5%. Interest rates in the United States averaged 5.42% from 1971 until 2024, reaching an all-time high of 20% in March of 1980 and a record low of 0.25% in December of 2008. I just thought that was kind of interesting where we're at in the rate cycle. Even though we're cutting rates, we're actually below our last 50-plus year average. And so if we keep lowering rates, we're going to be well below the average. But anyway, I just thought those were interesting little nuggets.
So let me correct something I said. So I pulled up another data source. And so when the Fed is cut in a normalization, right, trying to normalize, and when it's been more of a panic scenario. So when you look at 87, 98, and 2020, both of those scenarios, the market is positive 6 and 12 months after.
Yeah.
So, Lee, we're looking at the same thing here, right? And the recession cuts during a recession is when the market is lower 3, 6, and 12 months following. So whether the Fed is cutting in trying to normalize rates, or if it's kind of a panic scenario, historically, the market has done well, 3, 6, 12 months following. It's just when we're in a recession. So just wanted to correct myself because earlier I said
my question to you guys
different.
is that when the market seems to be booming, right? And economic data doesn't seem to be as bad as maybe we thought it was going to be or whatever. Everything seems to be fairly good from COVID and so on. It seems like and I know this is a dumb question, but we're lowering interest rates, and the Fed has been kind of pressured to lower interest rates, but we're lowering them below historical average. What's the point of that? And what is not? Why would we just not stay at historical average? Like, what is the catalyst that's making the Fed believe we have to lower rates?
Because in my first thought was because interest rate averages are not part of their mandate.
Right.
Their mandate is unemployment, and and inflation.
Right.
And so I don't think they have a mandate that states we need to be at the mean or the median or the average of long-term interest rates. I think it has to do with, inflation and
I think 2008 when after the financial crisis, when they took away some of the things that kept our interest rates in check for years and years before that, especially in the banking cycle, it's the wild, wild west, and the Fed can do whatever they want, and they don't have to have a rhyme or reason. There's no checks and balances on that. But I just find it interesting. I'm happy rates are going down. I think it helps everything from mortgage, like we said, from mortgage rates to interest on credit cards to everything. So, I mean, it's good for the economy. I have no problem with interest rates going down. I love it. I'm just curious, where is the end? Where are they going to stop that? Where is the happy point? And I know the inflation. So I worry a little bit about inflation creeping back in. And it may or may not, but you've got, it always is we don't know, right? I mean, we don't know until it
And correct
happens.
me if I'm wrong, but the Fed has much more direct control or impact on the short end of the curve, right?
Correct.
And so
Yes.
there's also the aspect of if you believe in market efficiency, which is a whole nother conversation, but if you believe that the markets are efficient and that the 10-year, which is set by the market, right? I mean, the Fed's not controlling the 10-year.
Correct.
Then we've still been in this inverted flat yield curve for a long time. And if we think the market is pricing the 10-year correctly, not saying it is or isn't, then the short end, what the Fed can control, needs to come down.
Yeah.
Right. And so that would be like an argument to say that's not saying that they're looking at that as a justification for why they need to cut, but that just says like, hey, the 10-year is pricing at this, in the open market, and the short end of the curve needs to come down because we can't stay in an inverted yield curve forever.
No, inverted yield curve traditionally means bad markets, and the markets are, that's not a good signal to the markets, right? If you go historically looking, anytime we've inverted yield, we've had bad pressure on the market, whether it be a recession or just bad cycle. But so this is kind of an unusual.
Sure.
This is completely unusual.
Our guest last week from JP Morgan, right? He was saying that, they thought the Fed would come down to kind of a normal range of like, what he was saying, what did he say? Like 3%?
Yeah. 3.25.
And then the 10-year would trade in that 3.5 to 4.5% range.
Right.
Kind of, moving forward for the foreseeable future. So, this is just looking at this year specifically. So everybody knew the Fed was going to start cutting rates. That was those were the expectations. Right. It was just a matter of when. Would they start in July? They waited till September and went 50. But looking at from July 11th through October 9th. So this was last week. So I got this from the Compound. They put out a chart that shows the biggest contributors to the S&P 500. So the biggest contributors through that time period were financials, industrials, healthcare, staples, discretionary real estate. Tech actually was the only sector that was negative since July 11th. So
in the 3 months.
In the few months leading up to, and then the month following, what has done the best. And it's, you can say things, the sectors and industries that are most tied to or directly impacted by, most interest rate sensitive.
And utilities probably have outperformed. I know utilities went from doing nothing to doing something in the last 6 months. Again, we've had that. So going back to 2022 when the Fed said they weren't going to raise rates, and then they raised them record amount of times in 2022. This year we had the same kind of issues. We thought they were going to lower rates early on, even in March, right? There was a higher chance of rate cuts in March than there was not having a rate cut, more than 50%. Didn't happen in the summer. It pushed all the way out. So tech stocks, I think, took a little bit of a little harder on the overall tech market because they're more leveraged. So they're paying higher interest rates until they lower rates. So I can understand why tech would take a little bit of a haircut there. And then I think techs are going to rally if we continue to lower rates. They tend to benefit the best out of that cycle. So maybe
I think too, the latter part of the summer, July, August, early part of September, I mean, there was some thinking that the economy was slowing down, significantly. Is a recession on the horizon? So that was what we were kind of looking at going into the first rate cut, and of course now, all the reports that are coming out, all the data that they're looking at, I mean, you could probably justify one rate cut from now to the end of the year,
right?
I mean.
Yeah, 100%.
Or none. Now, we know that's not going to happen.
Right.
But, you could, things are good.
There are some really good analysts that, we listen to, when you watch any shows, whatever, these people that have been doing this forever, that are touting that like maybe we shouldn't have a rate cut. But we're going to, most likely. But there are arguments that we shouldn't. Just leave it alone for a while, see what happens. And I think we've avoided, from COVID to now, this is the hardest market conditions I've ever looked at in my 25 years of trying to decipher what's going to happen. And we know on this panel, I'm what one of our clients say, I'm Eeyore in your Winnie the Pooh. Yeah, I'm the pessimist. I looked up Eeyore, like what was his thing, and it was like totally pessimistic, and I'm
Debbie
like,
Downer.
gosh. Yeah. So, exactly. So I don't want to be Eeyore anymore. So anyway, I've been the Eeyore on this panel.
Yeah.
And because, it's hard to me, all the stuff, the data to me is not clear. And it is a lot of the things, for example, like the inverted yield and the 2-year where it's at versus 10-year and so on. All of those things in history say the opposite of what's happened. Now, we've had stimulus, we've had all kinds of weird stuff thrown in the economy that's helped boost. And the only thing that I say that I, again, always have a pessimistic viewpoint here, is always keep an eye on the government spending aspect of our GDP and the government spending. And that has kind of been one of the leaders, which is not typically a good sign of health. But the government kind of feels like, and that's one of those, we talked about that yesterday, Friedman versus Keynesian way of thinking. I said Keynesian again.
Yeah, Keynesian. Keynesian.
Keynesian.
He said Keynesian in the hallway. I was like,
so it's the way you look at how the economic, cycle should work, and our politicians go with the Keynesian, thank you. And I think the Friedman is the way that I would look at it, less government. But anyway, I think those things are in there. Anyway, I'm rambling. I'll be quiet.
You are rambling.
Or we'll shut down.
Okay. So going back to, we'll kind of put a bow on this one, but going back since 1928, for what it's worth, the U.S. stock market has averaged 12 months following the rate cut, 11% for U.S. stocks, government bonds 6%, corporate bonds 5%. So that's over a 100-year period. That's the average.
It sounds good to me.
A lot of different scenarios, a lot of different reasons for those rate cuts, but that is the average. So jumping into a hot topic, which has been a hot topic for
a couple years,
3 years. Inflation. Wanted to dig into, spend a few minutes on where it is and where it isn't. As of recent, inflation is everywhere, so don't hear me wrong on that. But where it's kind of starting to come down, and then where it's still continuing to remain hot. So the biggest increase is 12-month change in price. Biggest increases are auto insurance, rent. I think everybody can feel the auto insurance, rent, housing. Earnings are up, restaurant meals, education, medical care. Those are the ones that are that have really just continued to come in hot. Auto insurance up 16.3%.
We felt that.
Yeah.
I definitely know that.
Home insurance, not just auto insurance, but home insurance. I don't even know if they put that on here, but I guess I wonder if that's under housing.
Could be.
But man, insurance in general is.
And the hurricanes aren't going to help that.
No. I mean, Florida, and a lot of those states that have been impacted.
Tornadoes through here, North Carolina, Asheville, the flooding. Yeah, insurance is going up.
So something you have to, and on that note, just while we're talking about that, that's something with, home values having increased over a long period, over the last few years, a lot. Right? Be sure you're reviewing your homeowner's insurance. I know we've had scenarios and heard of situations where, your homeowner's insurance doesn't increase automatically with the home value increase.
We found that out earlier this year.
Yeah.
We just decided to make a switch.
Yeah.
And when I was talking to, the guy that we moved our stuff to, it turns out, and again, Northwest Arkansas, home prices have gone crazy.
Yeah.
We were about $250,000 under
insured. Yeah. And I think I think a lot of people would probably be surprised by how much they are underinsured. So it's something to review regularly, have your policy shopped. So anyways, we don't sell PNC, but
we don't. But we have clients that were affected by the tornado that some of them learned the hard way.
Absolutely,
we have stories of that. They weren't quite
very
insured
important
enough.
I gassed up this morning, and I wasn't even thinking about it, but I've noticed that gas has significantly come down, and then the headline this morning is the price of oil's dropped today 5 or 6% due to a surplus. We're going to a slower season.
Yeah,
and so finally, there's some relief at the pump, but we've begun to see that,
which will help every part of inflation, right?
Sure,
obviously, because everything gets transported using.
So gas is down 15% over the last 12 months. Rental cars, used vehicles, John, all the toys you buy are down 2.9%. Hotel rooms, appliances, electronics, furniture, transportation, new vehicles, all down year over year. So, and some positives there.
Vehicles,
definitely positive.
Vehicles have really been down year over year, going back to probably 22 because they spiked so high during COVID when you could not find a car.
Yeah. Used cars were way up, and
and so now you've begun to see that over the last couple of years come down because
sure.
it was artificially high.
Right.
But
now, I know some food is getting pressure still, right?
And I was going through that now. It says how they break this down is kind of odd, but it says frozen juices and drinks jumped more than 15% year over year. I have no idea what they frozen juice. I mean,
I guess that's
beef.
like,
Beef is up. Ground beef rose
Yep.
4.7%. Steaks were up 2%. They break this down to the. I mean, it says roasts surged 6%. A little odd there, but
You know what's
things are-
interesting? They have various ways to gauge inflation. You know, they look at the average grocery cart. You know,
Yeah.
I mean, guys, it's high.
No, it's real
mean,
high.
it's just-
yeah. The grocery stuff has not come down. I don't. Well, at least from our.
No.
Yeah, and then you're reading that. Yeah.
Yeah.
Because
Yeah.
we get a lot of frozen.
But we
juices.
had, you know, I remember seeing an interview with the CEO of Kroger. I want to say it was, I know it was last year. He said that grocery prices would rise all the way through 24 into 25.
Yeah.
And I guess that's because of, you know, everything, you know, agricultural supplies
Yeah.
and so forth. But I mean, he saw it coming. You know,
Yeah.
we're not done with it. Could continue to go up into the next year.
I have some friends that are farmers in the Iowa area, and they are telling me that the cost of farming is going up tremendously, right?
Yeah.
And it's going to spread at some point. Well, it has already.
Sure.
But it's going to continue to spread to the consumer. So, I mean, I think food costs might be one that's going to take a little while to get our hands on. And the hurricanes do not help, because I think the frozen juices, you know, like orange juice, whatever. I mean, look at the wipeout of some of the stuff there. And so some of that stuff coming out
Sure.
of Florida, like the orange juice crop. Matt's too young to know trading places, but the orange juice stuff, you know, that was a big deal.
The
back
orange
then.
juice crop
Yeah, you had
So-
you bought futures on orange juice, but
directly
this
from
is-
our commodities expert,
Yeah.
John Martfeld.
Hey, Halloween candy looks like it's going to be up about 1% year over year.
Wow.
So-
Which is already ridiculous.
Budget that in when you're going out and buying the Smarties and the Twix
Well,
candy bars.
groceries are expensive. Eating out is expensive. We ate that. I forget where it was. We got food out the other night, and you know this is going. We don't have to go down this rabbit hole, but the whole like tipping inflation, where it's
Oh.
like, you know, they started. You have to be so careful
Yes.
because it started. You know, it usually is like 20%, 25%, 30%.
Yeah.
Well, it started on the left with the highest percentage.
Oh, so you
and
could
it was
easily
like,
just-
It was like 40, 30, 20 left to right.
Wow.
Yeah.
Interesting.
Well, you know what? Places are now, every place you go to now, there's a tip spot, right?
Yeah.
It doesn't matter where it's at. I want to say something.
We're about to go down a rabbit hole.
Yeah.
No, Fox. I was watching Fox Business this weekend, and there was the CEO of Walmart, our very own CEO of Walmart here, that I grew up with in high school, which is amazing. He's younger than me, but he was on there, and I thought that was kind of cool. I just
Who's
wanted
been
to
more successful? No.
Yeah, he's a slightly more. Yeah, he's slightly makes more. So, but he was on there, and I thought it was cool because I was like, okay, there's a guest on. I definitely want to watch this.
Yeah.
And he was talking about how Walmart is helping folks, you know, with inflation, and that you can have a turkey dinner, and he said that you can have a full turkey dinner for $16. Like Walmart is going to make sure that you can have a turkey dinner and I thought that was pretty darn cool to hear him say that, right? So although these inflation things are out there, there are places trying to make it affordable for families.
Now, that was last year's turkey.
Yeah. The turkey was
I'm
definitely out of date.
I'm kidding.
No, but I thought that was cool.
Yeah. Well, hopefully we continue to see prices, you know, inflation, not necessarily prices come down. Hopefully some prices come down. I wouldn't hold your breath on that too much, but just the rate of increase continue to slow down. You know, because I know everybody needs a little bit of, or a lot of bit of relief from that. So any parting thoughts or final words?
Earnings season. We're in the first few days of that. That'll be
it's-
very critical.
it's critical,
to
yeah.
see if this market can hold up going into the rest of the fourth quarter. We've got rates on our side, inflation's cooling. Now the question is, do corporate earnings continue, you know, beating that? And then the other interesting news today, and I just find this fascinating, the whole Amazon effect and the Walmart effect. Walgreens is closing 1,200 stores.
Wow.
I mean, you know, we kind of joke and say there's literally a drugstore on every corner in America. They're closing 1,200.
Wow.
And, you know, and that is a direct result of the Walmart, the Amazon effect on, you know, big box retailers.
Yeah.
And, you know, we probably haven't seen the end of it, but that's a big deal.
We had a retailer go file bankruptcy yesterday. Came out breaking
Yeah.
news. That used to be not. It was a hardware store.
True Value.
True Value. And that's terrible news,
Yeah,
right?
said
You don't wanna
I
hear
think
that.
Do It Best is going to buy them.
Yeah.
Which
So
is
I mean,
great,
yes, it you don't like to see it, but that's
I think corporate
part of
earnings. My last little word to say is corporate earnings. We can talk about all of these things: election, inflation, Fed, everything. The bottom line, corporate earnings drive the market.
Sure.
Period.
absolutely.
All that stuff matters to corporate earnings, right? Can affect corporate
And
earnings.
it can lead to short-term volatility.
Yeah,
but in terms
for sure.
of the long-term trend and trajectory of the market, it's like, are companies making money, and are they making more money and projected to make more money next year?
Yeah, exactly. Not only look and see if they meet their expectations for the previous quarter, but what's their
guidance?
What's their guidance, and are they lowering it? And that could put pressure on the market if you start seeing lower guidance going forward and so on. So I think we should pay attention to that very, 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 very closely.
For sure. So like we started, be sure to check your inbox, check Instagram for the survey we sent out. We would greatly appreciate you guys filling it out. Give us some feedback on what you want us to talk about in the coming week. So as always, we appreciate you guys listening, and we will see you next week.